Let's talk about one of the biggest financial stories right now, the basis trade. It sounds technical, but stick with me. I'll break it down using a super simple example. Imagine this. You run a small business. You take out a loan from the bank at a variable interest rate, which means your payments go up or down depending on the market. That's stressful. You never know how much you'll owe next month. So, you make a deal with someone else. You say, hey, I'll pay you a fixed interest rate every month, and in return, you pay my floating rate to the bank. That deal is called an interest rate swap. You're swapping fixed and floating interest payments. Now here's where it gets juicy. Let's say you agree to pay someone a fixed 5% interest rate, and in return they agree to pay your floating rate, which right now is also 5%. At first it's even. You both pay the same. But then interest rates go up. The floating rate jumps to 6%, then 7%. Now you're still paying just 5%, but the other person is stuck paying more because they agreed to cover your floating rate, no matter how high it goes. You win because you locked in a fixed rate and rates went up. They lose because they're paying more than they expected. That's the basic idea of an interest rate swap. It's a bet on where rates are going. And when hedge funds short swaps, they're taking the opposite side. They pay the fixed rate and receive the floating one, betting that floating rates will rise and they'll get paid more as they do. It's a powerful strategy, but it comes with big risks, especially when rates move fast. So, now that you get the swap part, here's how it ties into the basis trade. Big hedge funds like Citadel or Millennium take it a step further. They buy U.S. Treasury bonds, which are safe, government-backed bonds that pay a fixed interest rate. At the same time, they enter into interest rate swaps, where they pay a fixed rate and receive the floating one. Sounds a little strange, right? Why do both? Well, they're trying to profit from the small difference, or basis, between how Treasury bonds and swaps are priced. Usually, Treasury bonds and swaps move together pretty closely. But sometimes, due to market stress or supply and demand imbalances, a gap opens up. And when it does, these hedge funds jump in and try to take advantage of it. They buy the bond, which they expect to outperform, and short the swap, which they expect to underperform. If things go as planned, they make a small but steady profit. But here's the catch. Because the profit is tiny, they use huge leverage, often borrowing 20 times the amount of their own money. That turns small gains into big returns, but it also means a small loss can turn into a total disaster. And that's exactly what's happening now. The difference between treasuries and swaps, the basis, is acting erratically. As interest rates rise and liquidity dries up, the trade is moving against them. Now they're being forced to unwind their positions, selling treasuries, pushing bond yields even higher, and triggering more losses. It's like a line of dominoes, and the first one has already fallen. That's the basis trade in action. Simple idea, complex consequences. And when it's done with trillions of dollars in extreme leverage, it's no longer just a trade. It's a risk to the entire financial system. In simple words, if you buy the fixed side of the swap, that is, you receive fixed and pay floating, you benefit if interest rates fall because floating gets cheaper. If you short the fixed side, that is, you pay fixed and receive floating, you benefit if interest rates rise because floating gets more valuable.